Today's episode of Market Talk is brought to you in part by Growmark FS. Keeping up on the latest in ag is a challenge to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk for this Wednesday, August 4th. I'm your host, Jesse Allen. Great to have you here with us once again, making us part of your day. MarketTalkAg.com. That is our home on the web. MarketTalkAg.com is where you can find us anytime. Find all of our streaming sources and everything there. It's at MarketTalkAg.com. Well, soybeans had a good day today, but that was pretty much it. Everything else finishing lower here in the grain complex outside of beans and bean meal. We got plenty to unpack and discuss. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us here this afternoon. And Mike, interesting day in the markets. You know, since we turned this calendar to August, things have really just we've had a few interesting trading days already. And now today, looking like we might be turning lower across the entire sector. Then soybeans came back late. Very interesting overall with today's action. What do you make of what you saw today?
I think we're feeling the effects, unfortunately, of some of the things we talked about, especially last week and maybe even in a couple prior episodes, Jesse, when it comes to the macro headwinds and the outside markets and the dollar and COVID. I think what I'm seeing, generally speaking, in this market as we approach USDA's next WASDE report is less fear of weather. And this is even though crop conditions for corn slid another 2 points, and beans actually went up 2 points, which I'm not sure how you get from point A to point B on that one, but we'll leave that to the side for now. But you don't have the rains necessary to solidify a high yield that USDA is projecting right now, in my opinion. I'm not the only one saying that now, since some other folks are out there getting crop tours wrapped up. But those seem to be on the back burner now. And I think that back burner is that COVID is being traded through the energy markets. The energy markets are seeing supply increases, except for unleaded gasoline, but distillates, which is your diesel market, and your airplane jet fuel and your crude oil market are seeing increases in supplies. And I think this is kind of proof positive to the inflation bull that he's on the wrong side of the trade right now. And I think you're seeing these inflation bulls jump out of the commodities. We're seeing it in the copper as well at times. They're not doing it like all out risk off, but they're getting out gingerly. And I think it's because the COVID in the United States and in China is serious enough that lockdowns are increasing. Vaccination regulations for big employers like Tyson and Walmart. And just yesterday, I found out that China is going to essentially lock down and retest all 12 million people in the province of Wuhan because they are starting to see an outbreak again. All this flies in the face of a really strong economic bounce that continues in the second half of the year that started in the first half of the year. So I myself feel as though we're pricing in demand loss as we head into the WASDE report instead of weather premium. So that's kind of how I see it right now.
I'm glad you brought this up because you and I, as you mentioned, have talked about this on the last few episodes. And, you know, it seems like everyone wants to point to weather and making that the sexy headline, so to speak, in these markets. But it almost seems like the market is not only not necessarily trading the weather right now, but it's also maybe gotten complacent with the weather, especially the corn market. It just feels like, you know, we keep hearing hot, dry, not enough rain, but the market's really not reacting to that. It seems like it's some of these other factors that are on the table that the market's reacting to that folks aren't really talking about, or at least they're starting to finally talk about in trade.
Yeah, and I think that it's also, I think what resonates with what you just said is we're also kind of leaving out the demand side of the equation. The demand is not bad at all. I mean, we looked at China's June soybean imports from Brazil were just under 10.5 million tons. That was down a little bit from the record high set back in June of last year. but it's still up 14% from May of this year. You also saw Brazil soymeal exports hit a record this past month. You've got Tunisia buying wheat. You've got Algeria buying wheat. You've got some pretty decent demand side of the equation features going on in the background. Granted, we're not getting the flash daily sales that we were accustomed to 30, 45 days ago, and we've had some weekly export sales data that has been disappointing in the grains and negatives and marketing year lows. But by the same token, this week's export inspections for corn, I think it was almost 54, a little over 54 million bushels. And so I think if you look at all the factors, I would say we are probably more undervalue than overvalue in this market, especially when it comes to the corn. And I think that's where maybe the wheat and the corn and have a little bit of a different look to them than the soybeans do. In my opinion, when you look at all the factors involved, and yet it was the soy complex and the meal complex on Wednesday that really kind of saved the day. So is this just spread unwinding from what we did earlier in the week when the corn and wheat was shooting higher? I think that's the majority of it, along with some private trade guesses that are slipping the U.S. national bean yield to 50. And me personally, I'm actually below 50 at this stage and ready to pull the trigger for another half bushel cut in 10 days if we don't get any more rain than we've already had.
Let's talk soybeans because let's stay on that track. We know the soybean crop made in August. You just mentioned it rain. I mean, that's typically, we're looking for rain right now. We're going to see if anything verifies that's in the forecast. But just looking at the soybean complex right now, I feel like, especially the Northwestern Plains, the stories we're hearing from there, and maybe some of the stories we're not getting talked about. If we don't get those rains up there and we don't get that crop, I mean, I feel like there's a lot of upside potential in beans. I know you got a couple charts in your daily commentary, and I want to pull these up and talk about these here as well, Mike. But give us your thoughts on this soybean market and just where we're at and where we could possibly go price-wise in this market.
Yeah, I mean, I think August makes or breaks us, and I think this chart helps solidify that. We've talked about the fundamentals here, and this is the technical aspect of it, and this is a good representation of how I do my analysis for producers and for livestock feeders. If you're a hog buyer of feed or a chicken buyer of feed because you're raising birds, then undervalue is the one you want to look at. If you're selling beans because you're raising it, overvalue is the one you want to look at, because that's a price level that I feel like we've got premium in this market. How much premium? Well, it goes back to the carryover level. And what chart we're looking at right now, Jesse, is the new crop November beans. It's a monthly chart that takes out January and March and May and July and August and September futures. It's only November bean futures that you see on a monthly basis. And so what you see here is an expectation of an overvalue of $13.25. That has been met and exceeded, and that's assuming that I'm right around the correct carryover level of a 143 143 carryover here in the United States with the national yield of 49.8 bushels. And so my total production number is at 4.363. I'm a little bit higher in acres than USDA. I'm lower in demand than USDA, but yet I'm still coming in at about 12 million bushels lower than USDA's current estimate. So that's the fundamental aspect of why I think 13 and a quarter is overvalued. But I've told clients I feel like we can go back up towards the highs because that carryover can go down if we don't get rains in the next 10 days. And we've got, I think, the Chinese issues of the demand, the poor demand due to hog margins, ASF, so on and so forth. I think we've traded that long enough that the meal market looks healthy. Crush margins, I wish were a little bit better, but by the same token, I think the bean oil market is corrected substantially too. So I think we're in equilibrium on the product markets, and I feel like the $14 level, maybe even $14.60 area in November beans is still a goal to go back up to and retest if we get a continued dry weather pattern. Now, having said all that, you've got that orange trend line that really is a solid backbone to this market uptrend ever since we took off in late August, September time period of 2020. And so that trend line on a monthly basis is everything to me. In other words, I may believe we're at a 143 carryover. I may not want to sell any cash bushels of beans for recommendations or lock in any negative basis for recommendations to clients. But that doesn't mean I won't jump into those bought puts if we break that orange trend line, because that orange trend line has been intact for well over a year.
And you look at that orange trend line, I look at right where it ends at 14. And for me, in the soybean market, it just seems like every time we try to pop above 14, we get knocked back down. We pop above it, we get knocked back down. I feel like it's going to take a couple different combined issues to give us enough bullish momentum to break more to the upside, Mike.
Yeah, I think you're right. And I think this is where it goes back to if you look at the USDA's current numbers, their export number is pretty high. I think the trade's worried about the demand at this point going into the August trade report or August WASDE report. The trade is worried about that. Why? I think it goes back to the COVID. I think it goes back to the demand side of whether maybe China is going to have to slow down. But I think they're now at a point in China where they want to support the pig prices. They've cooled their consumer price inflation at the food level of the index, and now they want the hog producer and the poultry producer to be profitable again. And so that's how they manage their economy. They step on the gas, they step on the brake. I think it's more time for them to step on the gas and allow their crushing margins to improve and help their livestock industry produce as well.
You mentioned soy meal. You mentioned China. I want to flip charts here and talk about what you're seeing here on the soybean meal side. Again, that was the other market today that was higher along with soybeans, the only two markets that showed any strength today. But walk us through this chart and talk to us a little bit more about some of those products, specifically with soy meal.
Yeah, this is really where a command economy hits the rubber hits the road. You can have Chinese soy meal futures at $500 a ton, but you can still be bleeding red if you're a livestock producer or if you're a crusher, especially if you're a crusher. You would think with meal prices or meal futures that high, crushers would be doing really good to crush soybeans. And I think they are, generally speaking, in most economies, but in China it's different, Jesse. And so I think this chart, though, shows we are not expensive when it comes to our feed prices. And so what I look at the end of the day when it comes to the export market, other than the US dollar strength or weakness, is where are we in reference and futures and in cash prices into our major buyers and our major competitors. And in this situation with this chart, our major buyer, when it comes to crushing soybeans, they could literally send ship meal out of the United States and probably ship it over there cheaper than what it costs to crush right now. But China doesn't work that way. But even with that, we've got a premium in the meal futures that would suggest the soybeans here in the United States do have a good value to them, especially if we're trimming yields. And I will throw out also a chart that we didn't include in this week, is that now our price at the Gulf of Mexico for soybeans is about $20 a ton cheaper than Brazil. And I would look for that to continue, that our price would probably continue to cheapen to the Brazilian price unless the trade starts to worry about weather again. But these are some of the factors that bring me to that overvalue, undervalue level and make me think that August is still a decent month for a rally in the beans that give me a chance to hedge.
Let's talk livestock, Mike. The cattle market today showing some good strength in this cattle market. We've seen some good strength in the product market. And I mean, those two markets, the cattle side, the product side, I mean, the cash side, the product side, even they've been largely disconnected, it seems, for a while. But we've been looking fairly good this week in the cattle market. What are your thoughts on what you're seeing there?
Yeah, you've had a couple things that have really helped you. The pork cutout has really helped you with the cattle, and that's helped the hogs, which has helped the cattle. You've had a situation where the feeder cattle market has helped the cattle. And I think you've had a situation where new record highs in the equities markets like the S&P 500 and the Dow Jones have helped the cattle market in terms of sentiment as well. I think all three of those have run their course for the most part, though, Jesse. And like we talked about last week, any sign of weakness in terms of like new weekly lows in the feeder cattle or a break back below the current weekly lows in the fat cattle, that would initiate hedge recommendations on my plate right away. In fact, I put out a hedge recommendation to my clients and subscribers for feeders, a text blast that said, okay, we take out last week's lows of 157.60. get your hedges in place for the third and fourth quarter. Do 100% at this stage. I'm real close on the fat cattle to pulling triggers. Again, I talked about maybe by the end of this last week. Again, I'm here again with the fact that we've been able to take out the April highs in fat cattle as of Wednesday's high. We're now hitting multi-month highs, and I think we're coming into a seasonal time period where it's really tough to generate fresh buying interest at the retail level because we're starting to close out the summer and go into the school year. And this COVID issue is sincerely an issue. And I've had a lot more ranchers call me and say, I'm worried about my fat cattle price and getting hedges in place. So I think they're on the right track. So be a hedger in these markets, especially as we start up school until we know more about what the COVID issue and the policy is going to be for our consumption and our demand at the retail level.
You mentioned the pork cutout, looking at hogs briefly as well. That market down a bit today. I know there's some worries with COVID in China. We have the ASF worries out there. You name it. A few different things of concern for this hog market. But I know that pork cutout helping things out, at least here in the short term.
Yeah, I think the pork cutout's probably losing business now to the poultry side. And I think you're going to have to feed the bull, as we say in this industry. And I think that's where the weekly export sales come in on Thursday. If they can be really, really strong and China's in the top three on new purchases and still one or two on taking the physicals, we may be able to extend these gains on the funds. But I think the physical cash market at the cutout level is probably rich enough that we're probably losing some consumption and demand and seeing some substitution take place. So I'm not really eager to press the buy button here on the hogs. And I'm not a seller either. I just want to stay current. It's the hogs that I've wanted to help lead the cattle higher to get my cattle hedges in place.
And lastly, on the macro side, the outside market side, we've been having some trouble with crude oil here, back and forth with prices there, but the stock market been going to record highs. Talk about any outside factors you're seeing in this market trade influencing commodities.
Yeah, I mean, the biggest thing continues to be the COVID spike, but we've also had some really good Institute of Supply Management data in the service sector. In fact, this week's numbers was a record high ever since going back to 2008 that we've kept track of the Supply Institute of Management's index for services. So services are strong, but the manufacturing, both here in the United States, are starting to show some weakness. And I think this is the heart. This is the core and nucleus of why the energy markets are starting to soften, along with OPEC starting to raise their supply targets and their production targets. So much like the meats, I think the crude oil's been on this strong move higher, but I think we're long in the tooth in that. And as we talked about last week, we haven't gotten there yet, but I'm really hoping diesel prices and propane prices pull back so I can get my fall needs covered for clients.
Well, Mike, I know a lot of great insight you share with your clients and subscribers, globalcomresearch.com, and you got that free trial that we always encourage folks to sign up for.
Yes, please sign up because it's not just written copy like the soybean special report that you showed a couple charts of, but it's also audio and video and a lot of different media, so that it keeps everybody interested.
Globalcomresearch.com. That's where you head to check it all out. Mike Zuzolo with Global Commodity Analytics. Thanks for joining us here today on Market Talk. We will talk with you next week.
Thanks again, Jesse.
Mike Zuzolo joining us here today on Market Talk. Find us online, markettalkag.com. It's been the Wednesday, August 4th edition of Market Talk. I'm Jesse Allen. Have a great afternoon.